Hello students, in present video I am going to explain about the meaning and types of financial assets. First we will see the meaning of asset word. Asset is a valuable thing owned by one person or organization which generates income for a long period. For example, ABC Limited is manufacturing and selling pens. To manufacture pens in 2020 year, company purchased one machine with 10 lakh rupees. Estimated life of this machine is 10 years. So for 10 years, company is going to use this machine. Company is going to manufacture pens. By selling these pens, company is going to earn income. So this machine is useful to generate income for a long period. Therefore, to this company, machine is known as an asset. So these assets are divided into three types: real assets, intangible assets, and financial assets. Let us see the meaning of real assets. Assets which are tangible and visible are known as real assets. Tangible means we can touch them and we can see them. They have intrinsic value. Examples are land, machinery, furniture, plant, tools, equipment, vehicles, inventory, commodities, including agricultural products. For example, wheat, paddy, cotton, metals like gold, silver, energy products. For example, electricity, oil. Electricity you cannot touch, you cannot see, but it comes under real asset. Last one, wasting assets means quarries, mines. All these assets are visible and touchable, so they come under real assets. Next one, intangible assets. Intangible assets are not physical in nature, means you cannot touch them, you cannot see them. Some intangible assets are created by the business, and some intangible assets are purchased by the business from others. Examples are intellectual property. It includes know-how, means technology, copyrights, patents, trademarks, data. Then goodwill, reputation for the organization, brand name, franchises, customer relationships. Now come to the third type of asset, that is financial asset. This is the meaning of financial asset. A financial asset is a monetary contract between two parties which creates a financial asset to one party and a financial liability to another party. With one example, I will explain the meaning of this sentence. ABC Limited is one public limited company. This company needs 100 crore capital, and the company wants to collect this capital by selling equity shares. So company divided this 100 crore capital into 10 crore equity shares of 10 rupees each. Company sold these shares to 2 lakh investors. So these investors are known as equity shareholders. Here company is considered as borrower because company is taking money from others, and investors are considered as lenders because they are giving money to company. Who needs a written proof? Lender. So who has to issue that written proof? Borrower, company. Company issues that proof in the form of a document or in electronic form. So the document is known as equity share document. So this document contains the details of this contract. So here there are two parties, company and investor. So these two parties are entering into one contract. As per that contract, investor is lending some amount to borrower. In return, borrower is going to give some dividend to investor from profits. Not only that, borrower is transferring some ownership rights to investors. Thus, this equity share document acts as a written proof for the contract between these two parties. For investor, for equity shareholder, this written proof is considered as a financial asset because on this document, in future, investor is going to receive dividend and principal amount, and this document is treated as a liability, financial liability to the company, because in future company has to pay dividends and at the time of liquidation, company has to return the principal amount to equity shareholders. Thus, financial asset acts as a proof for the contract between two parties. For lender, this proof is considered as financial asset, and to borrower, this proof is considered as financial liability. Let us see the types of financial assets. We can see these 10 types of financial assets commonly. First one, cash and cash equivalent. Second, shares, debentures, bonds, bank deposits, accounts receivables, insurance contracts, pension fund, mutual fund, derivatives. In present video, first four I am going to explain. In my coming video, I will explain the remaining points. Let us start with the first one, cash and cash equivalent. Cash is a financial asset because it acts as a written proof for the contract between Reserve Bank of India and the currency note holder. So Reserve Bank of India issues currency notes now. So it is a promissory note issued by RBI. RBI is making a promise to pay the value which is signed by RBI governor. Currency note acts as a financial liability to RBI and a financial asset to currency note holder. Next come to cash equivalent. It is a financial asset which is accepted as a mode of payment. Examples, checks, commercial paper, traveler's checks, bank cards means debit card and credit card, short-term investments where the maturity period is not more than 90 days, money orders and bank drafts. Now come to second type of financial asset, shares. Section 284 of Indian Companies Act 2013 has given one definition for shares. A share is a share in the share capital of a company. Means what? With one example we will see. There is one public limited company known as ABC Limited. They need 50 crore capital. They want to color this capital by selling shares to investors. In that case, this 50 crore capital is known as share capital. This 50 crore will be divided by some amount. Say company divided this 50 crore capital with 10 rupees. Then 5 crore parts come. 5 crore units or 5 crore fractions come. Each unit is known as share. So this share price is 10 rupees no? This 10 rupees is known as face value of the share or par value of the share. So observe the definition. A share is a share means a share is a part in the share capital. In my example, share capital is 50 crore rupees no? So in this 50 crore rupee, each part, each unit is known as one share. Assume that there is one investor known as Prabhu. He purchased 10,000 shares at the rate of 10 rupees each. So how much money he invested in the company? 10,000 shares into 10 rupees is equal to 1 lakh rupees. So as a written proof, company issues share certificate to Prabhu. So that certificate may be issued in written form or in electronic form. So here that a share document acts as a written proof for the contract between company and an investor. So that a written proof is known as financial asset. It has some monetary value. The value of this share certificates is 1 lakh rupees. It acts as a financial asset to investor and a financial liability to the company. So when investor purchases the shares of company, some ownership rights will get transferred from company to Prabhu. So in this example, Prabhu is getting 1 lakh worth ownership rights from the company. So Prabhu is entitled to get a dividend from company's profits every year. And Prabhu can participate in decision making by giving votes. Shares are of two types, equity shares, preference shares. Equity shares are common shares. In case of equity shares, equity shareholders' dividend fluctuates. So when company is selling shares to Prabhu, company doesn't mention any dividend percentage on the share document. So the dividend payable to Prabhu depends on the profitability. If company gets more profits, Prabhu may get more dividend. If company gets less profit, Prabhu may be paid less dividend. If company gets loss, company doesn't pay any dividend to Prabhu. Even though company gets profits, company may decide to use that profit for other purpose instead of paying dividend to Prabhu. Thus, dividends are not guaranteed in case of equity shares. If you take preference shares, the dividend payable to preference shareholders is fixed by the company. So while selling preference shares to shareholders, company mentions the dividend percentage. Every year, company pays that much of dividend to preference shareholders. Even though profit is more, company pays the fixed amount of dividend to preference shareholders. And based on dividend payment, preference shares are divided into two types: cumulative preference shares, non-cumulative preference shares. In case of cumulative preference share, in 1 year if there is any loss, that year related dividend will get accumulated to next year. Means in next year when profits come, from that year profits, company will pay this dividend arrears also. Next come to non-cumulative preference share. It is equivalent to equity shares. Means if there is any loss in 1 year, then that year related dividend will not get accumulated to next year. Means shareholder has to forgo that year's dividend. Next come to repayment of principal amount. In this case, Prabhu invested 1 lakh rupees in company, no? So this 1 lakh rupees is known as principal amount. When it will be paid back? In case of equity share, this amount will be paid back by the company at the time of liquidation. If it is a preference share, then preference shares are of two types: redeemable preference shares, irredeemable preference shares. If it is a redeemable preference share, then while issuing the share to public, company fixes some term. So after expiry of that period, company will pay back their principal amount. If it is irredeemable preference share, then just like equity share, company pays the principal amount at the time of liquidation. And while paying the dividend amount, while paying the principal amount, first preference will be given to preference shareholders. Means from profits when dividends are paid to them, or at the time of liquidation from sales proceeds when principal amount is paid back, first company gives preference to preference shareholders. After paying to them, if any amount is left over, that amount will be paid to equity shareholders. Preference shareholders and equity shareholders both are treated as owners of the company. Therefore, when company is going to take important decisions, company conducts meetings and the shareholders participate in the decision making. So by giving vote, shareholders take decisions. Here, equity shareholders are having the right of taking decisions on all issues. But preference shareholders are invited to take the decisions related with their matters. Means equity shareholders are having 100% voting rights and preference shareholders are having partial ownership rights. While learning shares, you should know about the meaning of other word, that is stock. Generally, share and stock are used interchangeably, but there are some differences between these two. Let us see the differences between share and stock. Share and stock, these two words refer to ownership of the company. Stock means to keep. If investor purchases several company shares, then we use stock word. For example, Kiran purchased shares of Maruti company, Bajaj company and Infosys company. Then our statement is Kiran purchased stocks. Here I am not mentioning any particular company name. If investor purchases one company shares, then we should use share word. For example, if Kiran purchases Tata Limited shares, then our statement is Kiran purchased shares. If I say Kiran purchases a stock, then the meaning is I am telling about his habit. So this statement doesn't require any further questions. But if I say Kiran has purchased shares, then you will start asking series of questions. Which company shares he bought? How many shares he purchased? Equity shares or preference shares? Which one he bought? Stock word can be compared with the automobile industry. It includes two-wheeler industry, three-wheeler industry and four-wheeler industry. And share word can be compared with four-wheeler industry. Only one industry I am talking about. Thus, share word is a narrow word and stock word is a wider word. Share is a micro concept and stock is a macro concept. So this is all about shares. second financial asset. Now come to third financial asset, debentures. Section 2, subsection 30 of Indian Companies Act 2013 has given one definition for debenture. Debenture includes debenture stock, bonds, and any other instrument of a company evidencing a debt, whether constituting a charge on the asset of the company or not. Let us see the meaning of this sentence with one example. ABC Limited is one public limited company which is incorporated in the year 2011 with a share capital of 500 crore rupees. I used share capital word. Means what? Company collected this amount by issuing shares to the public. Assume company issued equity shares to 1 lakh equity shareholders and the company collected this amount. Now, in 2020 year, company wants to go for expansion. For that, company needs additional capital of 100 crore. For this additional capital also, if company issues equity shares, then existing equity shareholders' rights will get diluted. You know, equity shareholders are the real owners of the company. They have voting power. If extra equity shareholders come, then to existing shareholders it becomes a problem. So instead of that, company wants to take this amount in the form of loan. If company collects capital through equity shares, then this amount is known as equity share capital. If company collects this amount through loans, then this capital is known as debt capital. If company wants this amount for short period, for not more than 1 year period, then company can collect this amount in the form of overdrafts, cash credits or short-term loans. If company needs this amount for medium term, means more than 1 year period and up to 7 years period, or for a long period, means more than 7 years period, then company has to take loan from banks, other financial institutions like IDBI, IFCI, UTI, etc. Otherwise, by issuing debentures to public. Comparing to first two options, taking loan from banks or financial institutions, debenture is the best option for company, because in case of financial institutions and banks, security is compulsory. So without mortgaging company assets, company cannot avail loan from these organizations. But in case of debentures, we have two types of debentures based on security. Secured debentures or mortgage debentures, and second one is unsecured debentures or naked debentures. If company collects this amount by issuing unsecured debentures, then without offering any security to debenture holders, company can avail this loan from them. Not only that, comparing to banks or financial institutions interest rates, debenture interest rate will be lower. Suppose company wants to collect this 100 crore by issuing debentures, and company divided this 100 crore rupees with 100 rupees. Then this total debt capital is divided into 1 crore parts, 1 crore units. Each unit is known as one debenture. So company issues these debentures to public, lenders, investors. Assume 30,000 investors purchase these debentures. Then these members are known as debenture holders. Equity shareholders are owners of the company, but debenture holders are treated as creditors of the company. So company has to pay interest to creditors. To equity shareholders, to preference shareholders, company pays dividend now. In the same manner, to debenture holders, company pays interest. And in case of debentures, as this is debt capital, interest payment is compulsory. So company may get profit or loss. That profit may be adequate or not, but interest payment is compulsory. So while selling debentures to public, company mentions the interest percentage. So that much of interest every year company has to pay to them. So here there is a contract between company and debenture holder now. So as a written proof of this contract, company issues one document to debenture holder. That document is known as debenture. So debenture is an acknowledgement for the debt taken by the company from debenture holders. So that an acknowledgement comes under financial asset because it acts as a written proof for the contract between company and debenture holders. As debenture holders are outside of the company, creditors of the company, they are not allowed to participate in company meetings. So they cannot come to meetings, they cannot exercise any voting power. Then what about the return of principal amount? In case of debentures, based on redeemability, debentures are of two types: redeemable debentures, irredeemable debentures. Redeemable debentures means company issues these debentures for a particular period. When that period completes, company will return the principal amount to debenture holders. In case of irredeemable debentures, their principal amount will be paid at the time of liquidation. At the time of winding up of a company, from sale proceeds of assets, company will clear their dues. This debenture word is derived from one Latin word debere. Debere means to owe, to borrow. Companies borrowing money from lenders, no, from investors, no. That is the meaning of to owe. Now see the sentence. Debenture includes debenture stock, bonds. So in case of shares, I explained the meaning of stocks. If investor purchases the shares of two or more than two companies, then we use stock word. Here also same concept. If investor purchases debentures of two or more than two companies, then we use debenture stock word. Bonds. Our next point is bonds only, fourth point. There clearly I will explain about bond concept. Now you remember, debenture is considered as one bond. Stocks, bonds, and any other instruments, any other documents of a company evidencing. So, debenture document is one acknowledgement of debt. It is a proof, it is an evidence of debt. Evidencing a debt, whether constituting a charge on the assets of the company or not. I told no, based on security, debentures are of two types. If assets of the company are given as a charge, as a security, then these debentures are known as secured debentures. If security is not given to investors, that debentures are known as unsecured debentures. Just like shares, debentures also investor can trade through stock exchange. So in primary market, from company, investor purchases debentures. Then in secondary market, he can sell them at a market price. So this is all about third point, debentures. Next financial asset is bonds. Bonds are similar to debentures. In case of bonds also, when borrower takes loan from lender, as a written proof, borrower issues bond certificate to lender. So that bond certificate contains debt amount, duration, interest rate known as coupon rate, issue date, borrower signature, etc. Like shares and debentures, bonds also can be traded through stock exchange. So bonds are issued by these four entities. In case of debentures, company issues debentures, no? Means company acts as a borrower, no? In case of bonds, these four entities can be the borrowers. First one, government. If government issues bonds, these bonds are known as government bonds. So if government wants to provide infrastructural facilities to public, like constructing schools, dams, flyovers, bridges, for that purpose, when government needs funds, then by issuing bonds, government collects that amount. So if investor wants to invest in government bonds, then he can visit post office or leading banks. There is no risk in government bonds because government is going to issue them. Let us see some popular government bonds in India. Government of India Savings Bond, Sovereign Gold Bond, Capital Gains Bond, Indian Railways Finance Corporation, Tax-Free Bond. Next, companies. If companies issue bonds, that bonds are known as corporate bonds. Here companies means public limited companies. So for expansion purpose, to undertake new project, when company needs extra funds, then company may issue bonds. Interest rate will be higher than government bonds. Investing in corporate bonds is risky because investor is going to lend the money to private people. Next one, municipal corporations and local authorities. They need funds to provide infrastructural facilities such as constructing schools, constructing hospitals, parks, etc. Otherwise, for a specific purpose. For example, public water works. Last one, public sector companies. In any company, if maximum capital is contributed by government, then that company is known as public sector company. So these companies may issue bonds for expansion purpose to undertake new projects. Here also risk is less because these companies are supported by government. Let us see some popular public sector companies in our country. National Thermal Power Corporation, Oil and Natural Gas Corporation, Steel Authority of India Limited, Bharat Heavy Electricals Limited, Indian Oil Corporation Limited, Hindustan Petroleum Corporation Limited, Coal India Limited, Gas Authority of India Limited, Bharat Petroleum Corporation Limited, Power Grid Corporation of India, Bharat Sanchar Nigam Limited. Once you recollect third point, debentures. Fourth point is bonds. So generally people confuse between these two. They use these words interchangeably, but these two are not same. No doubt both come under debt instruments, but there are some differences between debentures and bonds. Let us see those differences. First difference is issuing body. Nothing but who acts as a borrower. Borrower only issues financial instruments now. In case of bond, bonds are issued by government, companies, municipal corporations and public sector companies. Debentures are issued by only companies. Second one is security. When borrower is issuing bonds to investors, compulsory borrower has to give a charge against asset. But in case of debentures, based on security, debentures are of two types: secured debentures, unsecured debentures. When company is issuing unsecured debentures without giving any security to the investor, company can take loan from them. Next, risk. As bonds are backed by security, in case of bonds, risk is less. In case of debentures, risk is high. In case of unsecured debentures, risk will be more. Next, rate of interest. In case of bonds, as security is given to investors, issuer gives less interest rate to them, and this interest will be paid on accrual basis. Means, for example, issuer issued bonds for 7 years period. When that maturity completes, then issuer gives principal amount and interest for the 7 years. Thus, interest will be paid at the end of maturity period. In case of debentures, interest will be high because company is not going to offer any security in case of unsecured debentures, and interest will be paid on periodical basis. Suppose one company issued debentures to investors for 7 years period. So every year company pays interest to them. At the end of maturity period, company returns the principal amount to them. Next, priority. At the time of liquidation, while returning the principal amount, priority will be given to bondholders. After paying to them, if any amount is left over, company gives that amount to debenture holders. Next, convertibility. Bonds cannot be converted into another form of security, but debentures, based on convertibility, debentures are of two types: convertible debentures, non-convertible debentures. If debenture holder purchases a convertible debentures, then after a specific period, he can convert that debenture into equity share. Next, tenure. Generally, bonds are issued for a long period, but debentures may be issued for medium or long period. So this is the end of present video. Hope this video is helpful to you. Thank you.